Hello, everyone, and welcome to week 4 of our course. So we have covered week 1, the environment of accounting, and I gave you several videos and then an assignment with the student template and then we went on to week 2, which is where you just had a test on chapter 1. And so for this video, what we're going to do is basically go through your chapter 2 assignment and your student template, and that will hopefully get you prepared to take your test for chapter 2. So the test for chapter 2 has some issues that I will go in and correct. It looks like it's been brought to my attention that 2 of the problems have some type of table and the table isn't showing up. So with that being the case, then I will absolutely go ahead and make sure that I give you credit for that. So let's start with the homework assignment for chapter 2 in week 3. And then we will go over that. And so that way you have the correct answers. So let me bring that up. And that way we can go over that. And I do think I have my stylus here, but we'll see. So let me make this larger so you can see it. So basically in chapter 2, what you should have gone over is all of this information. So for example, the following transactions occurred for Lawrence Engineering. And let me see if I can mirror this so I can annotate on it. 1 second here. So hopefully, let me see if I can do that. Let's see. Screen mirroring, display preferences again. Let's see. iPad Pro, there we go. Awesome. So, let's see. Perfect. Excellent. So let me just make this larger so that you can see it, and then I can annotate with my stylus hopefully on here. So let's see, let's do red. And so there we go. So we have on July 2nd that we received a $14,000 contribution from Brett Lawrence, the owner, in exchange for capital. So since we received cash, that's a debit of $14,000, and that's an asset account. And so if we recall, assets equal liabilities plus owner's equity. Oh, what happened there? Plus owner's equity, right? And so this is the asset side. So we know that we have a plus here. So we're going to have a plus here for owner's equity, which is Lawrence capital of $14,000. Then we move on to the 4th. Let me erase that here. So then we move on to the 4th, where we paid utilities expense of $370. So we know that utilities expense is an extension, right, of our owner's equity. And we know revenues minus expenses equals our net income, and expenses reduce our owner's equity, and it's also going to reduce our cash. So you see how we debited cash on July 2nd, but we're going to credit cash on July 4th to show that we're paying this utility expense, and then we're going to debit utilities expense for the $370. Now we move on to the 5th of July, where we purchased equipment on account for $1,600. So equipment is our asset account, and that's going to go up by the $1,600. But we didn't pay cash this time. What we did this time is we bought it on account. So that would be accounts payable, AP. And that AP has a credit balance and it's a liability. So we see the effect on the accounting equation at the top here as we're moving along. Perfect. And now we move on to the 10th, where we performed services for a client on account for $2,900. So since we performed the services, but they didn't pay us in cash, now we're going to have a debit of $2,900 in accounts receivable. So this is AR. So in our accounts receivable account, we're going to debit it for $2,900. So that's an asset, and that's going to go up. And then we have service revenue. So that's our revenue that's going up, which is also going to increase our owner's equity. So we are debiting accounts receivable for $2,900. And then we are crediting services revenue for $2,900. And then on the 12th, now we borrowed money. So now we are borrowing $7,100 cash and we're assigning a notes payable for it. So since we're getting cash, that's a debit to cash for the $7,100, and that's an asset account. And then we have a notes payable, which is a liability account that's also going to increase for the $7,100. So let's get rid of, oops. Oh. Let's see, let's get rid of all of these now so we can move on to the other entries and that way not make a total mess of our document here, right? Okay, so now we are going to focus on the 19th, right? And so here we have on the 19th that the owner, all right, so let's highlight that. The owner, which is Brett Lawrence, withdrew $200 from the business. So if he withdrew $200, that means that our cash is going down by $200 and that he's taken, so we're going to debit Lawrence and withdrawals. So the cash is the asset account, and let me show you that because we have a little bit of space here. So let me go back to drawing. So then if we do here, if we have assets equals our liability plus our owner's equity. So we have a reduction in the asset account and a reduction in our owner's equity with the Lawrence withdrawal. Okay. So then moving back up now, let's focus on this one where we purchased so we purchased office supplies for $840 and then we paid cash. So in this case, we're going to debit the office supplies, as you see here, for $840, and then we're going to credit cash for the $840. So if we go back and we see, so now we're reducing our asset account cash, and we're also adding to our office supplies. So in this case, both of these transactions, both of these accounts are asset accounts. One is decreasing the cash and one is increasing the office supplies. So we have just one side of the equation balancing out. So, and then we will go back up to see our last one, which is that we paid the liability from July 5th. So we'll highlight that, right? So we paid the liability from July 5th. So if we come here, here's our July 5th liability, which is our accounts payable for $1,600, right? And then when we scroll down here, we see that we're going to debit accounts payable to cash it out, and we're going to credit cash. So in this case, we're going to have a minus to cash, and we're also reducing our liability for the minus of the $1,600. So those are all of the entries that we have here. And so let's erase all of this and erase all of this. And so the effect on your accounting equation is what you need to keep in mind of. And so then what we're going to do here is we are posting these journal entries to the T accounts, and we have a cash balance of $18,090. And so that's our balance here, as you can see, the $18,090. So that's our check figure that was given to you. And basically you're going to open the following T accounts. So you have cash, accounts receivable. So here you see cash, accounts receivables, office supplies, right? As you see here, then we have equipment. Let's make this a little bit bigger so we can see nicely, right? Then we have equipment and accounts payable. So equipment is an asset, accounts payable is a liability. And then we continue with notes payable, which we see right here, Lawrence Capital and Lawrence Withdrawals, and our service revenue and our utilities expense. And those are all the accounts that were affected on the top here. So what you're going to do now is post the journal entries to the T accounts. And then you're also going to transfer the dates to the T accounts. And then you're going to get a balance, which will be a debit or a credit balance for each. So if we come up here, we have cash for $14,000 and Lawrence Capital for $14,000. So if we scroll down, we see for July 2nd, you're going to have your $14,000 here. So we're going to highlight the ones that we have gone over, right? And then we're going to go to Lawrence Capital for $14,000 here. So that's how you're recording. When we know, see, this is the debit and this is the credit, and debits always must equal credits. Then we move on to our next entry, which is where we paid the utilities expense. So we're going to have a debit of $370 for our utilities expense, and then we're going to credit cash. So let's start with the cash, and we see the credit here for July 4th, and then we scroll down to the utilities expense and we see July 4th. And we'll wait on the balance. We wait till we complete all of the journal entries in order to record the balance. Okay, and then we move on to our next entry, which is equipment. So we purchased equipment on account. So we know equipment is a debit, it's an asset, and then we are going to credit our accounts payable account. So then we're going to come down here and see the equipment for July 5th, and we're going to highlight that. That's our debit. And then we have our credit here for July 5th. Don't get confused. This is when we paid it later in the month. But so now and remember, you put your dates right next to it. So you have your July 5th of $1,600 and your July 5th here of $1,600 as well. Okay. And then just moving along, right, we keep going. So now on the 10th, we have that we actually perform services for a client on account. So we're going to debit the accounts receivable for $2,900 and then credit our service revenue account. So let's see how that looks on the T accounts here. So here we have accounts receivable for July 10th, and that's our debit. And then here we have our July 10th service revenue as well. So you see how each transaction, first we do the journal entry as we're doing up here, and then we actually record it in the T accounts. So now moving on to the 12th, right, we have that cash is debited. So we borrowed, we took out a notes payable. So we got $7,100 for cash. So that's debited, and we're going to credit the liability of notes payable. So then we move down to our T accounts here. And we see our cash, our debit of our cash for $7,100 on July 12th. And here is our notes payable, $7,100 as well. So the debits and the credits. And then we move on to the 19th. So now we are on our last three transactions. And this is the owner withdrawal where Lawrence took out $200 in cash. So we're going to start with the cash and put our balance here of the $200. And then we have a debit for Lawrence withdrawals. We do not net capital and withdrawals. We keep them in separate general ledger accounts. So I did notice that some of you did that. So we want to be careful. Then that's why we're going over this now. So that's how we record the withdrawal. Then on the 21st of July, we purchased office supplies with cash. So again, this was the side where we had the one-sided transaction. Assets equals liability plus owner's equity, right? So we only did it on the one side. So now we see that we're going to debit office supplies on July 21st. And then we're going to credit, we're going to credit it. We're crediting cash because we paid it with cash. So we have on July 21st, a credit to cash. And then our very last entry on July 27th is that we paid cash on account, right? So we paid off our accounts payable. So we see here that we're going to debit accounts payable, and then we're going to credit cash on July 27th. And then if you add up your balances, you would add up these two amounts and subtract these, you will get the balance of $18,090. And then you see here that we paid this off, so it's a zero balance. Your accounts receivable has a balance of $2,900, that one debit account. And then your office supplies has a debit balance of $840. Your equipment has a balance of $1,600. Your accounts payable has a balance of zero. And notice it's on the credit side because accounts payable typically has a credit balance. We still owe the loan, the notes payable of $7,100. Our Lawrence Capital has a credit balance of $14,000. And our Lawrence withdrawals has a debit balance of $200. And then all of these accounts up to here were all our balance sheet accounts, right? Assets equal liabilities plus owner's equity. So now we move on to the income statement. Revenues minus expenses equals your net income. So we have a credit balance of $2,900 for your service revenue and a debit balance for your utilities expense. So that is the second portion of your assignment for week 3. Now we move on where we're trying to correct errors in a trial balance. So our total debits equal $35,300. So this is your check figure here. And so we are given this trial balance from Joy McDowell Tutoring Services as of May 31st, 2018, and it doesn't balance, right? We see that there's 35,000 here in the debits and there's 33,100 in the credit, and these should equal. And we are being told here that this is 35,300 is what it should be. So we know that debits equal credits. So we know that both of these amounts when we're done with this should be 35,300. So what we start investigating, so investigation of the accounting records reveals that the bookkeeper recorded a $400 cash revenue transaction by debiting accounts receivable. The credit entry was correct, right? So if we're looking at a cash revenue transaction, we see up here, we had one, right? So we had accounts receivable service revenue. So if it were cash, this would be cash service revenue. So we know that the service revenue here is correct, but instead of putting it to accounts receivable, we should have put it to cash. That's what this transaction is telling us. Then we posted a $2,000 credit to accounts payable as $200, right? So the correct way to correct this would be I would reverse the $200 and record the $2,000. That's good accounting, and it provides us a good revenue trail, but you can also do the difference, right? Adding the 1,800. And then we did not record utilities expense or the related utilities payable in the amount of 300. So the entry for this would be, let's see, right? So if we do this, so if you did not record it would be debit utilities expense for 300, and then utilities credit, it's a credit. I'm just showing you these here so you know. Utilities payable for 300. So that's the entry here that was missing. And then you understated McDowell's capital by $100, meaning that you're going to have to credit it for $100. So let me erase that here. Perfect. So this is what we want to do here, right? So then we need to increase the cash by $400 and decrease the revenue by $400. So if you have here, you have the 2,800. So we're going to add 400 to that to get to the 3,200. So we're going to make a note of that. And then we want to decrease accounts receivable, right? So we have accounts receivable of 2,000. So we know that that's going to be 1,600. So that's our first correction. Then we need to increase accounts payable by $1,800, right? Or you could remove the 200 and add the 2,000, which will net your $1,800. So if we come up here, accounts payable is $11,100. And then we're going to add the 1,800 to get to $12,900. And we just showed you the entry for utilities expense, right? And utilities payable. So we need to increase that by 300. So if we look at utilities expense, we have 700. And if we add to that 300, you get 1,000. And then we look up here for our utilities payable, and that's $800. And we're going to add 300 to that, and we'll have $1,100 here. So that's that entry. And then we need to increase the capital by 100. So if we look at McDowell capital, we have 11,600 here. And we know that we're going to increase it by 100 to get to 11,700. And then if you add these up, they all total 35,300. And if I highlight this, I can show you in Excel. Let me highlight that and open up Excel here, so that I can show you how to do this quickly in Excel. And I love, accountants, we love Excel because it helps us with so many things. So let's make this a bit bigger so that you are seeing it, not microscopic, of course. So if I just take it, I just copied and pasted it from the Word document. And then an easy way is if you just highlight here and you expand it, you'll see. And then if you highlight up here, this little arrow, and you double click on the rows, ooh, let's do that again. And you double click on the rows, it automatically adjusts for you. So what I love about Excel is that you can do a simple formula. If you come up here to auto sum, and then you highlight all of the numbers, and you hit enter, it adds it up for you. And then if you click here and you hit up here copy, and you move over and you just click paste, it does the same formula here for you. And so that's the beauty about Excel, that within a quick amount you can see. And then an easy check is if you highlight all of this, you should also see down here the 35,300. So just as a good check as you're moving along, you see that here as well. And that is a quick and easy way to kind of do Excel. And so here we're going to call this, and then if you just click at the bottom here, we can call this the trial balance. Okay. Let's go back here. Ooh. Uh-oh. Let me get out of this. Uh-oh. Ooh. Oh, it's erase. It wants me to draw on this. No, not good. Let's see. Huh. Okay, I want to go back. Ooh, okay. No, I don't want to draw and zoom. Huh. No, okay. I don't know, it's not letting me move out of this now. It's exciting. All right, let's see if it'll let me go back into Word. No. Okay, I hope it's continuing to record. And yeah, I hope so. All right, well, I had a little bit of technical issues there because I tried to show you Excel and the screen recorder did not like that. And I also have the same screen recorder and it just doesn't, it gets a little, iffy with that. All right, so let's move to the last part of your exercise for week 3, which was your chapter 2. And here you were calculating the debt ratio. And keep in mind that right here, we had that total assets equal 174,900. Those are the check figures that I give you to hopefully help you develop the correct answer. So in this particular problem, we have that John Hart is an MD and he reported the following trial balance as of September 30th, 2018. And you see here we have the list of all the debits, which equal 256,700, and we have the credits that equal the same amount. So remember, in a trial balance, your debits equal your credits. So what you had to do for this particular activity is to calculate the debt ratio for John Hart. So the easiest way is your debt ratio equals your total liabilities divided by your total assets. And so here what we're looking is to see what our assets are. And so you see here we have cash of $90,000, right? I'm sorry, $30,000. So that's our asset. Accounts receivable of $7,900. Our office supplies of $300. Land is an asset. Land is an asset. And buildings are an asset, and your office equipment is an asset. So you would see that here, your cash, your accounts receivable, your office supplies, your office equipment, building, and land. And we see that here. Okay, and then we have our accounts payable, our utilities payable, our unearned revenue, that's a liability. And our notes payable, that's a liability, right? So you see accounts payable, utilities payable, your unearned revenue, and your notes payable. So when you add that up, and you can use that same Excel auto sum function, which we'll do, then you'll see that you have your total liabilities of $96,195, and you're going to divide that by your $174,900 to get 0.55 or 55%. So I am going to copy this and go back into our Excel spreadsheet here, and hopefully she likes this now, and try to show you the exact same thing that I showed you earlier, but using Excel formulas. Okay, so again, if you just click up here and you kind of extend it, you'll see that. And then if you click up here on this little corner icon, right, it highlights your entire cell. And then it means that what you do to one row or one column, it'll do to all. And if you just click here and you get the cursor to show you like this, and you double click and you get this information here. So what we're going to do is we're going to delete these and we're going to include formulas. And I'll show you how to do your debt ratio also in the same fashion. So right now we're going to add up our liabilities. And so we're going to go back up here again to auto sum. And you can highlight and it'll do that. Or another way that you can do it is if you come into formulas, auto sum is right here, and then you can just click sum, and usually Excel is smart enough to know that what the numbers are in front of it. Then you just hit enter and you get your formula here. So same thing, you can just come here to auto sum and see you could do averages, you can count the numbers, maximum, minimums, and there's a bunch of other functions as well. But for our case here, we're just gonna do auto sum and hit enter. And then the best way to do your debt ratio, right, is let's do this. I don't know, every time I add something on here, it wants to draw and I don't want it to draw. So I don't know why it's doing that. But anyway, what you would do is you would just take your 96,195 and divide it by the 174. And I'm going to try to do that by trying to see why this wants to capture this drawing here. And yeah, it just keeps wanting to draw as opposed to letting me. I don't know why it does that with the screen recorder. That's why I don't really like this particular mechanism of recording. I'll have to figure that out if I'm going to continue to use this, because it looks like, oh, maybe like this. Here we go. Okay, yeah, perfect. All right, so the easiest way to do this is to kind of type it in here, right? So here we would say total liabilities. Oh, here we go again. All right, I don't know. Well, you would type in total liabilities here and then total assets here. And then let me see if I can get out of this so it doesn't want to draw. I don't know. I don't know why it does that. All right, let's see. Well, and then you would just hit a plus and it should let me see if I can do this, because we're so close. So exit, maybe like that. All right, perfect. All right, so we would type in, so here, let me just try to do this. So let's do total liabilities, see if it likes this, because it seems like when I start to type, it doesn't like it as much. So, and that's the screen recorder issues there. I think next time I'm going to use Zoom, because I have a lot more annotation capabilities. And I don't get this issue with the drawing all the time. But anyhow, so here we go. And then what I like to do is come over here and put a little underline so that I know I have to divide, right? But then the beauty is that once you calculate it in a spreadsheet, then all you have to do is link. And that's what we recommend, to link to the cells, so that way if something changes, the amounts will change. So if you hit the plus sign and you click on your total liabilities, it will give you the B11, which is where I have the total liabilities located. Then you just hit enter and it automatically brings that number in for you. And then you would do the same exact thing for your total assets. You would hit the plus line and then select the cell. In this case, it's B20 that has total assets, and you can just click enter. Then what I like to do is highlight the two cells, and I like to click up here, merge and center, so that I show my formula here, right? So if you click merge and center, and then in Excel, when you're doing a formula, as you see here, it has an equal sign in front of it. It automatically adds the equal sign to show you that you're coming up with a formula. Or you can also do plus as well. So in this case, let's do equals, and then we're going to use this cell here. And then just like you see there, we're going to use the divide sign. In Excel, it's the little backslash. And then you're going to click on the bottom, which is your total assets, and then hit enter, and it gives you the 55. And if we want to put that in the form of a percentage, you click up here as a percent. And then you see it added it for you for 55 cents. So you see how quick and easy you can do this in Excel, and it comes out fabulously, right? And then if you change, right, any of these numbers, so say you had, instead of 30,000, you had 35,000 in assets, it automatically changes the number here, right? So then if I click undo up here, you see we had 174,900. Or if say we didn't have the accounts receivable, you just hit delete, and you see the numbers automatically change and your debt ratio changes as well. So the reason, I'll come back up here again and do a little undo to clear it, so that way we have the original responses here. But basically what you're doing is when you link the cells like we did here, hit a plus, and you see how when we hit a plus, it automatically added the equal sign for us, because that tells Excel that your equal sign is that you're giving them a formula. So that is the response basically for week 2, for your week homework. Week 3 homework. So what you're going to do for the assignment this week is you are going, when we go back into our class and we go into our modules, and for our week 4 here for your virtual classroom, you're going to review this video that we just went over, and you're going to add in here how well you did on the homework. So what did you get correct? What didn't you get correct? So make sure that for your week 4 virtual classroom tasks, you're providing, in the comments or in a document, how well you did, which ones did you get correct, which ones didn't you get correct, and then what you learned from this video. So that's what you're going to add into our week 4 classroom tasks, and I will grade that. So it's not a quiz, but it's like an assignment, and you can go ahead and put that in there. And then we will continue on. All right, so I hope you found this video useful and helpful, and I hope now you have a better understanding of our Chapter 2 assignment that we did in week 3. And don't forget to put how well you did, which ones you got correct or which ones you didn't get correct, right here in the week 4 virtual classroom task. And I will add this video to here so that you know exactly what to do. Have a fabulous rest of your day.